One number cost investors 10% in a single day this week. Another number made one of our holdings jump nearly 5%. The S&P 500 finished basically flat, but that flat line is hiding a war underneath. Tech stocks climbed, small caps got crushed, oil collapsed to prices we haven't seen in years, unemployment hit its highest level since 2021, and buried in all of this, a specific sector rotation that's creating opportunities right now. I'm going to show you exactly what happened, which sectors won, which got destroyed, and how our portfolio performed. Wins and losses, nothing hidden. I'm Burke every week. I break down what moved markets and what it means for long-term investors like you. I'm not here to tell you what to buy. I'm here to share what I'm seeing and how I'm positioning. You decide what fits your situation. Today we're covering a macro puzzle, winners and losers, an energy collapse, a pharma policy shift, and our portfolio. Let's get into it. Navigating the Great Divergence. That's what this week was about, a week of bifurcation where headline resilience masked deepening market fractures. If you've been following our market broadening thesis for 2025, this week is the test. Here's the split. Three numbers tell the story. Tech soars, the Nasdaq 100 gained 0.6%. AI and mega caps drove those gains. Broad market flat. The S&P 500 fell just 0.2%. Energy dragged it down while tech pulled it up. Net result basically unchanged. Small caps struggle. The Russell 2000 dropped 1.2%. Economic sensitivity weighed on smaller companies. Now, if you watched last week's review, you know we've been tracking market broadening. In late November, small caps surged nearly 6%. In early December, the Russell hit all-time highs. Does this week break that thesis? No. One week doesn't reverse a trend. Small caps react faster to headlines, up and down. The unemployment number spooked some investors. Thin holiday volume amplified the move. The mechanics still hold. Rate cuts benefit smaller companies with floating rate debt. That hasn't changed. We're treating this as a pause, not a reversal. The macro picture looks like Goldilocks on the surface, but look closer. Cooling inflation. Headline CPI 2.7%, core CPI 2.6%, both are below expectations. This validates the Fed's dovish pivot. Rate cuts are doing their job on the inflation side. That's the good news. Now the concern, labor. Unemployment hit 4.6%. That's the highest since 2021. This number triggered recession indicators. Some economists are asking whether the Fed is behind the curve. Here's what this means for you. Disinflation is confirmed, which supports equity valuations, but labor market softness is the key risk. A soft landing is still possible. The runway just got narrower. This labor number is exactly why small caps pulled back. They're more economically sensitive. When unemployment spikes, investors rotate to safety, which means mega cap tech. Sector performance tells the divergent story in detail. Consumer discretionary led with a 1% gain. Tesla's robotaxi progress drove that. Amazon's holiday strength helped. Technology followed at 0.6%. AI demand confirmation from Micron earnings lifted the entire sector. Healthcare gained 0.6%. There's a pharma story here involving a policy shift and a dramatic divergence between two weight loss drug companies. Then there's energy, down 3% for the week, the worst performing sector by far. Oil collapsed, energy names capitulated. We have exposure here, and it cost us this week. When tech and consumer discretionary lead while energy lags, you're seeing the market reward growth and punish commodity exposure. That rotation matters. Let's look at specific stock moves. Winners and losers. Winners first. Carnival Cruise jumped 9.8%. Why? Fuel costs. Oil's collapse is a direct windfall for cruise operators. Lower fuel expense flows straight to the bottom line. Micron gained 7%. Their earnings confirmed AI memory demand remains strong. That's a read-through for the entire semiconductor supply chain. Oracle up 6.6% on cloud partnerships. AMD up 6.1% on market share gains versus Intel. Now the losers. Nike dropped 10.7%. China's weakness continues to pressure brands with heavy international exposure. Diamondback fell 5.5%. Broadcom dropped 5.44%. Permian Resources lost 5.3%. Two of those three, Diamondback and Permian, are in our portfolio. Both got hit by the oil collapse. Let's talk about energy because this move hit our portfolio directly. WTI crude oil fell below $55 per barrel, multi-year lows. Three factors drove this collapse. First, geopolitical de-escalation. Progress on a Ukraine ceasefire removed the war premium that's been baked into oil prices for years. Second, supply glut. U.S. production hit record levels. Meanwhile, China demand remains weak. Too much supply, not enough demand. Third, technical breakdown. Once oil broke key support levels, algorithmic selling accelerated the move. Machines don't care about fundamentals when support breaks. For investors holding energy names, including us, this week hurt. But here's the other side. For the broader economy, lower oil is disinflationary. That supports the Fed's rate-cutting path. That supports equity valuations broadly. Short-term pain in energy, medium-term benefit for the market. Now to pharma. A significant policy development this week that directly benefits one of our largest holdings. 9 pharmaceutical companies reached a drug pricing agreement with the Trump administration. Eli Lilly, Bristol Myers, Merck, major names. The trade-off: lower prices on Medicare and Medicaid drugs in exchange for a 3-year tariff exemption. The market read this as a net positive. Here's why. Tariff uncertainty had been hanging over pharma stocks for months. This deal removes that overhang for 3 years. Government pricing concessions were coming through negotiation anyway. Better to trade something you might lose for something you definitely gain. For our holdings, notably Eli Lilly, this provides clarity. Clarity lets companies plan. Planning supports investment. Investment drives returns. Here's what worked in our portfolio this week. Tesla gained 4.9%. Robotaxi testing in Austin progressed. Their full self-driving software received upgrades. The market rewarded execution on the autonomy roadmap. Eli Lilly added 4.3%. 2 catalysts. Their oral weight loss pill hit phase 3 success. That's potentially shifting from injections to pills, which expands the addressable market dramatically. Plus, the policy clarity we just discussed. NVDA gained 3.4%. Micron's earnings confirmed AI memory demand remains strong. That's a direct read-through for NVIDIA's data center business. When memory makers report strong AI demand, GPU makers benefit. These 3 holdings, Tesla, Eli Lilly, NVIDIA, represent our secular AI, weight loss drugs, autonomy, trends that don't depend on next week's economic data. Now what didn't work? I promised transparency. Diamondback Energy fell 5.5%. Oil price collapse hit them directly. They also announced 2025 capex cuts, which shows management responding to reality rather than pretending prices will rebound quickly. That's actually disciplined behavior. Broadcom dropped 5.4%. Custom AI chip margin compression spooked investors midweek. But here's what matters. It recovered Friday. The sell-off was overdone. Absolute profit dollars are growing even if margin percentages dip temporarily. Permian Resources fell 5.3%. Same story as Diamondback. Oil price collapse dragged down the entire sector. There may have been some residual overhang from the private equity share sale back in September, but this week's move was about crude prices, not dilution. Weeks like this happen. Energy exposure hurt. Tech and pharma helped. We own these businesses for their multi-year competitive positions, not their weekly price movements. This slide shows why individual company analysis matters more than sector bets. Eli Lilly, dominant, up 4.3% this week, up 39% year-to-date. 3 catalysts. Oral pill success expands its addressable market. Policy clarity secured, execution continues. Now look at Novo Nordisk. Same industry, same obesity drug trend. Penalty box, down 4.17% this week, down 44% year-to-date. What happened? The failure of an Alzheimer's trial removed a major growth leg investors had priced in. Competitive threats rising, partly from Eli Lilly's oral pill. Supply constraints persist. Same sector, same trend, wildly different results. We own Eli Lilly and Novo. This is why we don't just buy sectors. We analyze individual businesses. These 2 are in the dominator monopoly bucket. They have an early lead in the dominant GLP-1 weight loss market. Earlier this year, both presented us with the opportunity to own these high-quality companies at a discount with pleasant 20% return on invested capital. We bought both when they were down 30% or so for the year. Lilly's share price has recovered nicely while Novo is going through a transition and the share price has not yet caught up. We think it will over time. One thing to remember is that although Novo is down some 50% year to date, we are not down that much in the stock because we have been averaging down since we bought it. The market has priced Novo at $48 or 13 times earnings, assuming it is a broken growth stock. Our model considers that the current crisis is operational, supply chain spending, not structural. Demand for these weight loss drugs is massive and growing all over the world. If new CEO Dowstar's restructuring, cutting 9,000 jobs, saves the promised $1.25 billion annually and supply stabilizes, margins will expand even if revenue growth remains moderate. If margins do stabilize, investors will likely re-rate the stock from a distressed 13x PE to a mature pharma 18x, 20x PE. We could see the stock up 60% in the next 2 years. Before I wrap up, here's what to watch next week. Tuesday, core PCE and final Q3 GDP. PCE is the Fed's preferred inflation gauge. If it confirms the cooler CPI reading, rate cut expectations solidify. Also, Tuesday, consumer confidence. Does the market rally translate to Main Street optimism, or is there a disconnect between Wall Street and real households? Thursday, weekly jobless claims. Given the 4.6% unemployment rate, this data point gets extra scrutiny. Any spike reignites recession fears, and throughout the week, thin holiday trading volume. That amplifies moves in both directions. Don't mistake noise for signal. Low liquidity can make small moves look dramatic. Here's where we stand. Our investment thesis is intact. Disinflation confirmed. Fed rate cuts support equity valuations. That backdrop hasn't changed. Labor is the key risk. 4.6% unemployment threatens the soft landing narrative. We're watching this, but it doesn't change our long-term positioning. Selective growth wins. AI and GLP-1 weight loss drugs provide secular growth engines. These trends don't depend on next quarter's GDP print. On market broadening, our 2025 thesis hasn't changed. Small caps had a tough week, but 1 week doesn't reverse months of improving breadth. The mechanics that favor smaller companies in a rate-cutting environment remain in place. Our portfolio is positioned for long-term wealth creation through disciplined exposure, quality compounding in our 3 buckets. Number 1, ownership companies. 2, dominant near monopolies. 3, cannibal companies. We expect all of our stocks to double every 3-5 years. That's a 15% to 25% compound annual return. That's the week. If this analysis helped you understand what's happening beneath the headlines, consider subscribing. We do this every week. And if you're serious about building a portfolio of quality businesses for the long term and want to discuss how dynamics like these apply to your specific situation, the consultation link is in the description and the pinned comment. Thanks for watching. Have a joyful Christmas week. I'll see you next week.